China's economic crisis. Will money printing save the market? I. China's real estate crisis, an ongoing earthquake. Real estate accounts for 25% to 30% of China's GDP, making it the most crucial pillar of the economy for decades. However, this sector is now collapsing severely, with alarming statistics. Continuous house price declines. For 7 consecutive months, as of February 2025, new home prices in 70 major cities have dropped by an average of 8.5% year over year, the sharpest decline since 2015. Source: Reuters. Plummeting home sales. The total value of home sales by China's top 100 real estate developers fell by 45% in 2024. Source: Bloomberg. Massive oversupply. It is estimated that there are over 20 million unsold apartments, equivalent to 3 billion square meters of housing space, a staggering figure. Source: Nikkei Asia. Fire. Why is the market collapsing? 1. The 3 red lines policy. 2020. The Chinese government tightened credit to real estate developers, making it impossible for them to borrow more funds to complete projects. 2. Investor panic. After the Evergrande collapse, market confidence plummeted, causing both homebuyers and investors to withdraw. 3. Aging and declining population. China is experiencing record low birth rates, leading to a sharp decline in housing demand, putting pressure on the market. Economic fallout. A spreading nightmare. The real estate crash is not just affecting investors, it is dragging down multiple sectors. 1. Financial sector under severe strain. 50% of Chinese bank collateral consists of real estate. As the market collapses, many banks are facing the risk of bad debts. Evergrande owes more than $300 billion, while Country Garden and other major developers are also on the brink of bankruptcy. The total debt of Chinese real estate companies exceeds $5 trillion. Source: FT, and foreign capital outflows. In 2024, China lost over $120 billion in foreign investment, the worst figure in 2 decades. Source: WSJ. 2. Labor market suffering deeply. Unemployment in the construction sector has reached 30%, leaving millions of workers jobless. Youth unemployment hit a record 21%, forcing the government to stop publishing unemployment data from August 2024 to avoid public panic. 3. Slowing GDP growth. China's GDP grew by only 4.6% in 2024, far below the 6 to 7% average of the previous decade. The World Bank and IMF have downgraded China's growth forecast to below 4% for 2025, signaling a significant slowdown. Some text goes here. 3. Will China turn on the money printer? To rescue the economy, the Chinese government has limited options, and printing money may be the last resort. Currently, they are taking the following measures. 1. Cutting interest rates and injecting liquidity. The People's Bank of China, PBOC, has reduced the reserve requirement ratio by 0.5%, injecting around 1 trillion Chinese yuan, $140 billion, into the banking system, and lowered lending rates from 3.55% to 3.25%, but with limited effectiveness due to low market confidence. 2. Real estate bailout package. The government has pledged 300 billion Chinese yuan, $42 billion, to buy unsold homes, but less than 5% has been disbursed. Major cities like Beijing and Shanghai are testing housing subsidy policies to stimulate demand. Some text goes here. 3. Is the money printer strategy feasible? If the government decides to significantly expand the money supply, 2 scenarios could unfold. Scenario 1. Positive. If money is directed towards sectors like technology, manufacturing, and domestic consumption, it may help stabilize the economy. Scenario 2. Negative. If uncontrolled money printing leads to rising inflation, a depreciating CNY, and continued capital outflows, the economy could spiral into crisis. Currently, the Chinese government is trying to control the flow of money, but market pressures may force them to print more money to avoid a deeper recession. Some text goes here. IV. Can China overcome this crisis? The biggest question now is whether the Chinese government has enough tools to control the situation. Several factors could help them navigate this crisis. China still holds over $3.2 trillion in foreign reserves, providing short-term stability for the currency. The government has tight control over the financial system, limiting the spread of the crisis. Technology and manufacturing sectors are still growing, partially offsetting real estate losses. However, if China fails to restore investor confidence, the risk of a prolonged recession remains high. China's economic crisis is not just about real estate, it is a crisis of confidence. The government faces a tough choice: tighten financial policies to restructure, accepting short-term recession, or print more money, stimulating the economy but risking inflation and a weaker CNY. In the short term, it seems China will opt for a middle ground: controlled monetary easing and selective support to avoid a severe shock. But in the long run, if the market does not recover, the government may have no choice but to turn on the money printer, even more aggressively. Fire, what do you think China will do? Print money or tighten policies? Share your thoughts. Rocket.